Hey everybody, it's Personal Finance Friday, and today we're talking about the costs involved in investing. We'll be right back. All right, so today on Personal Finance Friday, it's costs involved in investing, but not all costs. We're leaving out a big one called opportunity costs because that would take 3 or 4 more episodes by itself. So today is just about actual costs. Investing is, in theory, supposed to help you make money. But as the old saying goes, you have to spend money to make money. The idea, though, is to keep your expenses to a minimum or your spending to a minimum and maximize your profit. But what are the costs involved in investing? Some are obvious, some are not so obvious. But let's go through a couple of them. First off is taxes. Now, I consider that one to be the most complicated, but there's just so many ways you can be taxed on your investments or avoid taxes on your investments, and that's what makes it complicated. Now, if the majority of your investing is done within the confines of your qualified retirement account, your 401k or your IRA, then you don't have to worry about the tax implications. Nothing you do inside those accounts is going to create a currently taxable event. No dividends, no buying, selling, there's no such thing as capital gains taxes inside that account currently or anything like that. In contrast, if you're doing your investing in a standard brokerage account, often referred to as a taxable account, then anything you do in that account can have taxable implications, whether it's buying or selling with gains or losses, dividends that you get, anything like that would be currently taxable. The only exception to that will be certain tax advantage investments even inside a taxable account, for example, muni bonds. Keep in mind though that inside a taxable account, even trading that happens that you don't personally do yourself can affect you. If you happen to own an actively managed mutual fund and that mutual fund is buying and selling things, then that can have taxable implications for you. And of course, any dividends that it throws off would be taxable for you in the same year as well. The next obvious cost is brokerage commissions. When you're buying and selling things in your account, even if it's somewhere like a discount brokerage, TD Ameritrade, Schwab, something like that, you're paying for the privilege to buy and sell, and that's fairly straightforward. Now, depending on what kind of account it is and which firm you're with, the level of those costs will fluctuate. What you pay may be different, but you're paying something to do it. Now, mutual fund investors have some special costs, mutual funds and ETFs, and let's talk about that. All mutual funds and ETFs have something called an expense ratio, which is expressed as a percentage of the assets held. So you'll find mutual funds with expense ratios listed, these days can be as low as 0.05%. You'll find others that can be 1.5%, maybe even 2%. So the range can vary quite widely. But ultimately what it means is that percentage of those assets is what these guys are taking in order to manage that fund for you. This is particularly true of an actively managed fund. Those will be higher. But it's the administrative costs and their computers and all this other good stuff that's embodied in that expense ratio. And that's the fee you pay to them for the privilege of owning their mutual fund or ETF. Some mutual funds have another expense called a 12B1 fee. Now what that fee is a sales and marketing expense used by the mutual fund company to push it to other broker dealers, smaller broker dealers, financial advisors, and things like that, so that they will sell it or push it to their clients. Now that fee can be as much as 1% on top of the expense ratio. So if you have one of those expensive, actively managed mutual funds, like I mentioned just a moment ago at 1.5%, and they have a 1% 12B1 fee, you're losing 2.5% of your potential return on that investment. Mutual funds and ETFs also have a hidden expense that they don't tell you about. It's not included in the expense ratio information that you see in the prospectus. Now what that is trading costs. It's expressed in the prospectus as the turnover ratio. Again, you'll see that on Yahoo Finance, etc. But that turnover ratio tells you how often or how actively the manager of that fund is buying and selling stocks within it. The more they buy and sell, the more they're paying in trading fees. Just like you would pay if you were buying and selling your own stocks, you'd pay those per share or per trade buy and sell fees with Schwab or TDA. The managers of these mutual funds are also paying, although they're paying quite a bit less than you, but they are still paying to buy and sell shares inside the mutual fund. A turnover ratio of 20% is fairly low, and that means their trading costs will be low, and it won't drag on your return as much. A turnover ratio of 120% means it's fairly active, and the trading costs will also have a corresponding impact on your return from that fund. There is data and studies available that you can look at in other locations. I can actually link some of it in the comments below. That'll show you the impact of trading fees on mutual fund returns. But depending on the type fund it is and how active it is, the drag on your returns can be upwards of 3%. So that's a very quick, basic rundown of investing costs and things to look out for. Thanks for tuning in. Please like, share with your friends if you think it'll be of interest to them, and have a great weekend. We'll see you again.